Market decades illustrate the benefits of risk management. People get overwhelmed by market performance and lack thereof. This high-altitude visual can anchor your clients on the benefits and value of risk management. Hey, welcome again to The Rare Advisor. Today I want to chat with you about the stock market, and in particular how a high altitude view will help you in having literally decades on your side to illustrate for you the importance of proper portfolio development, and most specifically why risk management is vital in the financial plan, in the estate plan, in the retirement plan, and specifically inside of the various models and tools that you are using in the portfolio that you are crafting for your client. People have various ways of digesting what goes on in the market. Some of them are totally oblivious to it. They don't want to think about it. They don't want the risk. They don't want anything that goes along with the stock market. Others are enamored by it. They're constantly wondering about crypto and GameStop and all this ridiculous social media hyped types of investments where there really is no merit in it. It's just a matter of being a flash in a pan, and they're wanting to somehow figure out how to capture that lightning in a bottle. The reality is, if you are working with someone who's either rapidly approaching retirement and or they are in retirement, the last thing they should be doing is trying to catch that lightning in a bottle. However, what they should be doing is taking a very solid, methodical look at risk management and why it's so important in the portfolio, and why it is that you, as their financial advisor, need to bring this equation onto the table and need to have these conversations with them. So the first thing they have to do is digest what's really going on. You would be shocked how few people, I should say, really understand what the stock market has done over the last few decades. So that's where I would like to start that conversation with you. I'm going to do a quick share screen here so we can jump right into this and just show you from a very high altitude how decades of market performance can truly illustrate for you the benefits of risk management. Here is the S&P 500. I've broken it down into the last 3 decades plus what's occurred since the beginning of 2020. And as you can see, it is a very different ride that has taken place, a different slope, a different experience that has taken place in each one of these decades. Now, I've got them all strung together here, but let's talk about, what happens when you piece it apart. So if we are looking at this whole big picture, a passive investor, the vanguards of the world and various other groups who really focus on passive investing, they will argue that this is an argument for passive investing, because if you start here and you end here, then, over time, the stock market has prevailed. And while that is very true, and we actually have passive models that are available to you through USA Financial Exchange, because there are periods of time or certain components within a portfolio in which you might want to have a passive type of approach. But what that negates is the fact that people are living during this 30-year time frame that I just showed here. Meaning this is not just a short blip in time where you can say, oh, I'll wait that out. You've got long 30-year periods of time. Well, if somebody is retiring at the base of one of these downturns, if they're retiring right here, and this is what they thought they had, you've got a whole different conversation on your hands. So let's slice and dice and piece this apart for you real quick. If we just start with the first decade on our list here, the 1990s. Now, during this period of time, this is a passive investor's utopia. This is what they would hope for, because the market is relatively stable. If you look at the line from, again, this high altitude, obviously the closer you get into it on a daily or an hourly environment, you're going to see much more blips on the chart. This is a monthly chart, so you're seeing it's kind of smoothed out, if you will, over these 10 years. And it looks like, basically a ski jump. You would think, if you didn't know any better, that if this is all you knew about the stock market, this 10-year time frame, you would think, hey, that makes a lot of sense. I'm just going to invest it. I'm going to forget it. I should invest all of my money in here. I don't have to worry about things like fixed index annuities or guarantees or income protection or any of these other things, because this looks so simple. This is the era in which passive investing really took off because of the performance that we had experienced during that time frame. But we all know that's not where the story ends, because the next period of time now comes down the .com starting of that bubble pop. So what people didn't totally understand at this point in time is that there was a bubble happening here towards the end of the 90s with the .com. So now as we come into the 2000s and we look at the next 10 years, now suddenly what looked like a ski jump has suddenly turned into a roller coaster. We see a dramatic drop for the first few years. Then we see a nice run up for the next few years. And look at that. We've gotten right back to essentially where we were. So everybody thought, oh, problem solved. Now we're back on. The passive thing will work, right? But no, of course not, because then we end up in the financial crisis and we get a little bit of a bounce here at the end of the 10 years. But what has happened here, if you were looking at this 10-year time frame, you started here, you ended here, this ends up being the slope of your experience with a very, very wild ride in between. So what would have happened if you had some risk management in here and you were able to flatline some of these valleys and then start growing during some of the mountain periods again, but avoided some of the big troughs? That would have been very, very valuable to somebody. What would happen if somebody was right here on this particular day, if they were 10 years away from retirement, and then this was the day they planned to actually retire? Would they still be able to do that? That's a really good question. There were a lot is an understatement. There was a historic amount of client complaints filed in the with the regulators during this period of time because people thought this is what it was supposed to be, and then it ended up here. And then they thought this is what it was supposed to be, and it ended up back here, and so on. So very, very tumultuous time. This is one of the primary reasons risk management is so, so important. And then we move on to 2010 through 2020. And suddenly we've got ourselves a heck of an upward slope again. Now, what you will notice is it seems to be quite a bit choppier, however, than it was the first go around in the 1990s. So although the growth is there, there's a lot more volatility that's taking place today. And I would argue a lot of that has to do with simple technology advancements. We are in a 24/7 cycle now in terms of market and news media. So people are investing in ways they've never done before. The small investor is weighing in and swaying the market, and they're up all night long trading, whether it's on crypto or Forex or on the stock market itself. There are all kinds of boards on Reddit and all the things that you've heard about that drove the scenarios for GameStop and some of the others. All of these things are now in play. So it's not just the traditional approach to investing, but also you're seeing ETFs have now made a huge impact on what's occurring during this 10-year time frame. Because now suddenly you don't have to always just focus on a stock basis, or you don't have to just focus on the overall market as one big, huge, giant pot represented by a single ETF, where it's just kind of this big sluggish thing that moves in general upward or downward trends based on the overall market. We have so many different ETFs available to slice and dice the market apart. You know, even just the basic idea that if you've got an S&P 500 ETF, and then you have an S&P 500 value ETF and an S&P 500 growth ETF, what you're going to find is that the market, that overall index ETF, will always kind of be in the middle. And then either growth is leading the charge or value is leading the charge, and vice versa. Now, they will crisscross each other as they change over the guard, so to speak. But other than that crossover point in time, you're always going to have either growth leading the index or value leading the index. So by having the three versions of it, you've got the overall index, which is kind of the middle ground. You've got then growth or value to bookend it. And that's just one small example. There's a million different ways to slice and dice. So suddenly the market is very complex. And once again, as you can see, risk management still becomes important, because look at this right here. That was 2015. Here's 2016. So that was a pretty significant drop. And then 2017 is back up here. We saw the same thing here. We went from here down to here. So, you know, what looks like small blips on a chart, when you're looking at this high of an altitude, you're talking about 6 months, 12 months, 18 months on some of these swings. If you're looking at where we were right there down to right here, that is a year's time frame and a very significant swing. So although the market looks like it's generally heading up, and it was generally heading up. Obviously, we have different things happening. And then from there, we stepped into the pandemic. So here we are. It's kind of hard to see with being this far over on the chart, but right there is where we started the year. And then right here is where the pandemic took us, right almost out of the gates in the end of February. And since then, we've been climbing up, but it's been very volatile, and we've seen a lot of volatility as of late. So suddenly people who have been constantly getting bombarded with the idea that, you should be a passive investor. That was the battle cry for many years, and you didn't hear as much about risk management. Today, I would argue, thanks to the internet and everything else, people are starting to realize, after losing immense amounts of money not understanding risk management, that it is important to have risk management baked into your portfolio. Whether it's a blanket you're throwing across the portfolio, things that will trigger you out of the market, out of equities and into debt and equity, or whatever the case, or debt and bonds, I should say, whatever the case might be. Or maybe it's something you're baking into the individual models. And again, sometimes it's very sensitive. Sometimes it's more of a broad market approach. But this is the key to successfully navigating this entire process. Because if you can capture a fair amount of the growth, flatline through some tough times, and then capture a fair amount of the growth again, you're going to be much farther ahead than if you are riding the roller coaster. We don't know what these next 10 years are going to bring. We know that stimulus and the Biden presidency has been good for the market in the short term, but we've been seeing a lot of volatility lately. And we also know that stimulus is going to eventually catch up and be a drag on the market as well and the economy. So these things are weighing against each other. And you have to be able to manage that inside of the portfolio. So as always, USA Financial creates different market pieces that talk about the stock market. The marketing team here has been updating those for the new year. Those are available to those that are affiliated with USA Financial. If you have interest in some of this stuff, you want to reach out to us. As always, contact one of our business development consultants here at USA Financial. They'd be happy to help you out. But keep in mind, it's important to explain the longer term scenario for consumers as to what it is you're doing in the portfolio. I always suggest you give them a big view like this, and then you can zero in, because we want to be able to show them the effects of the roller coaster ride during the 90s. We want to be able to show them what's occurred since then. We want to show them the volatility that's happening more recently as the economy and the market and information just moves so much more rapidly than it used to. All of these things are important in portfolio development. It's why we run USA Financial Exchange. It's why we partner with so many high quality asset managers, most of who have different risk management approaches to their models and to their investment portfolios that they can help you build. So again, thank you so much for all that you do. I hope this has been a helpful oversight in terms of how to bridge the conversation into risk management with your clients. Thanks, everybody. Talk to you again soon.